All right, outside of stocks, here's a look at global commodities and currencies. Oil, what we just talked about, the Iran sanctions officially going back into place today, but it hasn't really mattered. Crude oil actually down right now because Saudi Arabia is pumping more, Libya is pumping more, Nigeria is pumping more, and that has the world well supplied with oil. We're at $62.85 for the price of crude oil here. Let's talk more now about these markets. Joining us, Joel Shulman. He is founder of ERShares. Joel, welcome. It's great to see you again.
Thanks. Good being here.
Okay, well, I guess there's two ways to look at this. I mean, we've had this insane volatility. The markets were very weak for a while. The fact that we were able to end last week somehow higher on the Dow, does that give you any reason for optimism, or do you think this volatility is going to continue?
Well, I think we'll see volatility continue through the end. I mean, when we talk about the corporate profits coming in from China tariffs, we looked at 1,176 companies, 412 mentioned China tariffs as an issue. Of those that mentioned China tariffs, they were off about 12.5%. Those that didn't were off about 10.5%, and the S&P was down 9.3%. So as corporate profits continue to come in, I think we're going to see it. But, you know, I'm generally optimistic for the end of the year. I think we're going to end the year higher. And we're still seeing lots of good numbers for corporate profits up from last year compared to this year.
The numbers are, and I don't use this word lightly, spectacular for corporate profits.
Yeah, they
mean, if I would have come to you and said, hey, Joel, we're going to have 24% profit growth year over year, one of the best numbers we've ever seen in the history of the United States, but the market would struggle to stay afloat, you would have probably called me crazy.
No, I mean, you're absolutely right. I mean, the corporate profits are fantastic. I'm bullish for the rest of the year based on this. And when we look from year to year, we have to remember that up until a couple months ago, I mean, the markets were way up across the market for growth, you know, small cap growth, large cap growth. I mean, we had funds up over 30-something% for small caps. Large caps are over 20%. So we had a hiccup. Is that the word to say for October? It was off from 18%, 18.2% for the FANGs. But we had a lot of flows going out. I mean, we have to remember that passive money now is up to about 1.8 trillion in the large caps, and compared to 1.3
You may have heard somebody on this network saying that they were concerned about what ETFs may do to the market, because we've never really had a market that has been this passively invested.
That's absolutely right.
And I don't like the word passive anyway, because, by the way, if you see huge outflows in trillions of dollars, that's not passive.
Right.
What is going to be the ultimate impact?
Well, I mean, to your point, you know, with this money going out, in and out, and I do have one ETF, I have 3 mutual funds, but with the ETF, the money moves in and out without regard to valuation. And to your point, I mean, this is a real problem for the markets. I mean, individual investors, savvy investors, high net worth, and hedge funds, you know, they take large positions. But when you're talking about these baskets, these institutions moving 1.8 trillion, which is up from 1.3 trillion last year, and they do so without regard to valuation, this is a real problem.
Stock picking. And no one's knocking the ETF business. All we're saying is you've got a bay, a bay, and there's 5 super tankers in the bay and 100 smaller boats around them. When the tide goes out, they're all going to go down, or they're all going to come up. And that's I think, the concern that some people have.
I'm in complete agreement on this. And so I don't know what's going to change. I mean, I think ultimately what happens is savvy investors figure out how to pick off these things. When you think about...
do you go back to just stock picking?
Well, so that's what we do, right? So we have our baskets that move with the markets, but we take a subset of it. And so there's a book years ago by Charles Ellis talking about winning the loser's game. So there's essentially 2 ways. You know this book?
Oh, absolutely. We did a panel with Mr. Ellis in Phoenix back in February.
Okay, so many of your listeners probably know. So the 2 best ways to beat the market: you get rid of the bottom part, right, and the rest will be fine, or you try to concentrate and get a little bit more of the top. Now, Ellis talks about getting rid of the guys at the bottom. So we're trying to do both things. So your stock pickers are trying to get rid of the guys at the bottom, which by definition is going to put you better than average. But if you can also get a higher percentage of those at the top, you're going to have a double benefit. And that's what we're trying to do by picking off our entrepreneurial companies, large cap, small cap, and global.
But Charles Ellis also said on the panel to me that basically any concern over passive investing was silly. He's like basically just, you know, he didn't use that word, but he, well, I got the point.
Yeah, I mean, traditionally, you know, the people have a hard time being the baskets, you know, because they're also, the baskets are done without regard to fees. And so, but if you have models, and, you know, some of us think we have models that go back over time that beat the market, and they have a particular factor that you can accentuate, then that's one way to do it.
Help us make a little money then before you go, Joel. What looks good right now?
Well, I mean, we still, I mean, small cap growth.
Still.
It got beat up. I mean, it's down half from where it was. I mean, it's still the leader globally. It's down from half of where it was. To your earlier comment, profits are way up. I mean, at some point, people are going to recognize these profits, right? And large cap growth, I mean, got beat up also. And that previously, I mean, so both of these areas, at the end of the day, if profits continue to come in and we see good numbers trickle in November, December, we have a nice Christmas, a little rally with retail, people are going to say, profits are way up. Why am I not in there?
Is that chart does not say trade war. That chart of the small caps, we can bring it back up, says people are concerned about the economy going forward. Are you worried about the U.S. economy?
Not in the next year. Certainly not through January. I'm certainly not through January. I mean, let's see what happens February. I'm not worried about the interest rates. I'm not worried about oil. I'm not worried about inflation. The trade war, if we have a good deal with China, we're going to see markets, I think, up 5–10%. I mean, this is not just me. I think most of us think the markets will respond positively. And even if we come out kind of neutral on that, I mean, I think at the end of the day, people are going to look at these profits and they're going to see good numbers come in. And at the end of the day, profits kind of carry the market.
24% profit growth year over year, one of the best numbers we've ever seen, but we got a lot of volatility in there as well. Joel Shulman, ERShares, always a pleasure. We'll see you soon. Thank you very much.
Thanks.